All right, welcome back to Investing Wizards. I have the pleasure of having Liberty on, and it's really the first guest that I have on the show who is an anonymous account on Twitter. So that's why you're looking at sort of my picture and his Liberty icon without seeing any faces. So because Liberty is an anonymous account, we're not going to reveal his face or identity. But Liberty, thanks for joining us.
Thanks for having me.
Yeah. So I was introduced to you, or I met you on Twitter, where I've met a lot of interesting investors, a lot of interesting people, and just started kind of like following your content and stuff you talk about. And you have a really great pulse on companies and themes, and really go into the weeds on fundamentals. Really kind of having a view on different things, as well as having a view on different TV shows. And some of the kind of like medical trends that are going on. Like I know you talk about this ring that you wear all the time. But I'll shut up now and I'll let you introduce yourself. And would love to kind of get a background in terms of how you got into investing and what your investment style is.
Sure. Yeah, no, Twitter is so great. I've met so many great people there, and including you. My background is kind of weird because most people I meet, like they work in finance, they work on Wall Street. Most people doing this full time anyway. I've been in the industry or I've studied it. I've never actually studied finance or even tech. I've never worked in the industry. It's just kind of something that started as a hobby and that grew into now being a full-time investor. I actually studied law, but like hearing this, someone may think, oh, he knows about all the legal stuff and all, but I've forgotten all of it. Like I did that because at 17 you have to pick somewhere to go, and like math and science is hard in school. So what can I pick that's not going to be as hard? Like it's weird how we make these decisions so young and so when we're so stupid, and then we have to live with them for a while. But anyway, that was kind of not such a productive period. But out of law school, I did at JD. I joined a media startup and worked there for a while. And while I was doing that, I got into investing at first with kind of in low cost indexing and the Vanguard stuff and the Bugleheads and all that. And then I found a biography of Warren Buffett, which kind of started the switch towards like stock picking. And I just loved it. I just like, I think my ideal kind of job is being a detective. Like you're trying to figure out a story. Like you start with a blank page and you're trying to figure out how something works. What's the story behind this? And so in the media world where I was, that's kind of what we did. In law, it's kind of similar in some ways. You kind of build a case, you try to figure out all the moving pieces and what everybody does. And investing was kind of like that, but even cooler because I could kind of mix it with some of my other interests in science and tech. Mm-hmm. So I was doing that on the side as a hobby, like kind of like, I don't know, 20 hours a week or something. But then my wife and I had kids, so it wasn't possible to do it all anymore. And that's when I left the real job and just started doing the investing full time, and kind of just learned it by myself. I think internet forums and Twitter were kind of the main resource because I don't know anybody in real life like working in the field. Like I'm near Ottawa in Canada, so I'm not like on Bay Street or on Wall Street. So it's all been online people like helping me and learning from them. And something I've been thinking about recently is how my investment style, like I do it kind of as a lifestyle design. And by that, I mean, I realized explicitly, because it was implicit before, but I'm not trying to have the best absolute returns on my money. Like if I was, I may be doing different things. But if, for example, I found out that the best returns would be in some sector that I don't care about, like I'm not interested in it. If like I thought the best returns would be in like junior miners and oil and gas or something, like I have no interest in there. So I don't want to spend all of my time with these companies thinking about them all day, reading about them all day if I'm not interested. So my interest in technology and science have kind of, pushed me towards that side of the investment world. And I've been lucky because, it happens that this side has a lot of great businesses with attractive economics and, good people. And they've had many tailwinds recently. That's kind of luck. I'll take it because I have to take the bad luck too. But anyway, that's kind of how I ended up there. And as you may tell from the accent, by the way, English not my first language. I'm a French Canadian, so if you have trouble understanding, that may be why.
Yes, so far so good. So you invest in stuff that you kind of care about and could dig into, which is kind of cool. But then when you said, when you say Warren Buffett, I think of Benjamin Graham. Is your style like a value biased investing style, or is it just that you got into stock picking then and like do you have a bias to your investing style?
It changed a bunch over time, I think, and most investors probably go through this, but at first you have to figure out your own style. So at first you're copying other people's styles. So at first, like when I learned about Buffett, I mostly knew about like Berkshire and other similar companies. So Fairfax and Markel and Nvidia at the time. And like that was kind of my starting point. Then as I was reading about Fairfax, these guys were a bit more deep value and they like hairier situations. So I kind of tried my hand at that, but I was terrible at it and did very bad. And so it's only over time that I've kind of evolved into more of a, it's a cliche, but the high quality compounders and technology companies and all that, that it happens to be kind of my style. I know it's very trendy these days. Everybody seems to love these companies, but it just so happens to be the stuff I'm comfortable with and that I think I understand better. And I also I can't follow 50 companies and constantly be selling and buying. I don't have the bandwidth to do that. So I'd rather concentrate on fewer companies with great management that does a lot of the capital allocation for me, and I can just hold for a while. Because some people may have better returns by constantly optimizing their portfolio, buying and selling as soon as something looks a bit expensive, but I don't have the bandwidth to do that. So I prefer these stocks for that too.
Yeah, and how many stocks do you own in your portfolio, and how many stocks would you say you follow?
I think I own something like 17, but it's like my top 3 is maybe like 40% of the capital. Wow. So it's pretty concentrated. I tend to have these things that I'm super confident in them, and that's partly because I know them. I've known them for a while, but also some companies they're internally diversified. So if I own something that has 200 units that's in geographies all around the world in different industries, and it's one stock in the portfolio, but it's very different from another stock that may be one product in one geography. It's a very different risk profile. So I feel more comfortable with some of these very internally diversified companies. And I follow, I'd say maybe, I don't know, I never counted them, but maybe another 40 or 50 things, but some of them I know well, some of them I'm just starting to learn about.
Cool, very cool. So this is a great segue to actually talking about some stock and some investing. So let me kind of share my screen and we'll move on to the portion where we talk about some investment ideas. So tell me kind of what are some of the ideas and themes and stocks that you're thinking about right now?
In recent times, I've been learning more, and I guess I should preface all of this by saying that I don't really know anything. As I said, I've just studied it. I didn't work in the industry. I don't have inside sources, and so sometimes a lot of people will say, "Oh, I know this about that company," but when you start thinking about it, how do you really know? You maybe read it somewhere, or you assuming that they're doing it this way because you kind of know the company. But so all this to say that this is what I think, this is what I've learned about, but nobody should take that to the bank. So in recent times, I've been learning a lot about semiconductor companies. Mm-hmm. I think it's super interesting technology. It's I think was it Gavin Bigger saying that it's the closest thing to magic that we have. They're all these processes to deposit a few atoms layers on top of stuff. It's crazy. So one I like is Texas Instruments. Not saying I like it as an investment or a recommendation, but I find it very interesting because at first glance, they may look like just another big semi that's been around forever and they're super large cap, but the space that they're in and how rational management is makes them stand out to me. A big chunk of their revenues come from analog semi. So a lot of the time with these big digital companies that everybody knows about, it's super competitive space. They have a few big headliner products that they're big targets for competition. And every year they have to improve them constantly, or somebody else is going to catch up, or they may lose market share. With the space that Texas Instrument plays in, they have thousands and thousands of SKUs. They sell these small chips that they may sell for 75 cents, a couple bucks, and these things are designed into all kinds of stuff like cars and industrial machineries, and their sensors and all kinds of pieces of equipment. And once some engineer designed his system and has a few Texas Instrument chips as part of the system, the same design may be in production for 10 years, 15 years, 20 years, and there's very, very little incentive to change these chips because they're not the big, it's not the CPU in the computer. You're not going to sell more of your thing if you improve that small little chip in the corner, that's a sensor or something. Mm-hmm. So there's very little incentive for competition to try to compete on these things. And just the catalog of chips that they've built over the years, thousands of them, even if you started to try to compete, you'd have to build up your own inventory of SKUs and it would take years and years and years. And another thing that keeps competitors away is that analog and digital semiconductors are designed very differently. Oh. So you can take engineers from one side and put them on the other. It's a very different, it's almost more of an art because the analog is basically you interface with the real world. So in digital, it's all ones and zeros, it's all the software. But when you go on to an analog chip, it may interface on one side with the digital, with the software, and on the other, it may be some actuator or some sensor that does temperature or movement or something. and that's a lot. That's very different. And there's not a ton of new engineers coming to the field. A bunch of them are kind of been around forever, and there's not a huge wave of replacement coming in. So that's another reason why these companies are they're very, very hard to compete with. Yeah, as you can see, the revenue is there. Of course, it's cyclical, but it's so diversified by SKUs that if right now, automotive has fallen like a ton. It's starting to come back, but like it's hard because the pandemic is pretty different from a normal recession or downturn. But some part of the catalog may be doing badly right now, but some other part might be doing well. So they're pretty diversified there. And even with those cycles, management has been really good and rational about taking advantage of when things go wrong. Like in the great crisis in 09, they bought a ton of like equipment from other company, used equipment for like pennies on the dollar. They're kind of value investors in that way. Like when their stock gets cheap, they increase the buybacks. When it gets more expensive, they'll invest more through the income statement, more R&D. And yeah, management there is super rational. They're one of the only companies that I know that does like an annual presentation just about capital allocation, with a presentation where they're going to tell you like, okay, this year we're going to invest in this for these reasons. We're thinking about buybacks and dividends this way. We're going to return X% of free cash flow to investors, and they lay it all out so you can know exactly what you're getting and how they're thinking about things. So that's one of the reasons I think they stand out.
So when you mentioned before that you're looking for compounders and efficient capital allocators, this price chart would suggest this fits the bill very well. Kind of like a hallmark characteristic is a stock that goes up very steadily as that compounding effect is felt and is realized. And what you mentioned before is kind of this, like if we look at net income in the 90s and 2000s, in the 2000s was very cyclical. You had kind of like boom and bust cycles here. And then over the past 10 years, you've had this kind of diversification where the net income, even though maybe the growth rate hasn't been, and we could put growth rate here in a sec, but it's not like net income is accelerating, but the fact that it's so steady and not as cyclical gives it this much lower volatility for the stock price.
Yeah, and because they're buying back a lot of stock, the free cash flow per share, which is what they focus on, has been growing faster than the absolute numbers. And what you notice about the kind of, they got less cyclical and more predictable. That's another big thing that management did. It didn't happen by accident. They're very good about exiting worse business lines and getting into better ones. And over the past few years, they've decided to ride a few big secular trends, which are the analog content into automotive and industrial. This is almost impossible to imagine that industrial machines and equipment are not going to get more semiconductor content over time to make them more efficient, more smarter. That automotives, we're already seeing it. Electric cars use a lot more semi content than internal combustion cars, but even more recent internal combustion engine cars have a ton more stuff with the entertainment systems and the sensors and the security stuff and the self-driving stuff. So these trends are going to continue for a while, and they're trying to ride these trends and exit less attractive businesses. So that's made the stock more predictable.
Interesting. And as you mentioned here, the shares outstanding have been just steadily declining for the past 15 years. So even though net income is going on by a healthy amount, EPS is increasing even faster as they sort of use their cash flow to buy back some of the shares. I remember when I started working at a team, and the last job I had before Koyfin, I remember kind of like this argument where someone said, Texas Instruments is a great kind of like example of where the semiconductor industry is evolving, in that kind of like before 2015 or before 2012, the multiple that these semi companies traded at was sort of like single digits. It was a sort of like, between 8 and 15 times. And then over the past several years, the multiple has expanded as investors, as this business became less volatile and as it became more steady. So these are now more trading like industrial companies with a steady cash flow rather than semiconductor companies, whereas we saw kind of in the 90s and 2000s, the cyclicality was much higher, and the risk of actually going bankrupt or losing your money was much higher than it is today.
Yeah, and this is exactly the kind of company where the quality of management matters a lot, because they have so much capital to reinvest. Like normal times, they may have like 40% free cash flow margins. So if you have bad management that wants to build an empire and does a bunch of M&A, and someone could do very bad things with that type of business by trying to grow at all costs, while the Texas guys, they focus very much on free cash flow per share. And everybody else may be doing M&A, and there's a big party going on, and they stay disciplined. They'll wait for the right time to do M&A, and in the meantime, they'll just either buy back stock or build some new fabs that are going to pay off like in 3 years, 5 years. They've been doing stuff that's so predictable. Like most of the other analog guys, they fab their chips on 200 millimeter silicon wafers, and Texas Instruments has been moving to 300 millimeter wafers. So that's kind of geeky, but that's what that gives them is a cost advantage. So the gross margins have been steadily rising as they've been transitioning all of their fabbing over to the 300 millimeter stuff. And so it's predictable that for the next few years, the gross margins are going to go up just from that fabbing tailwind. So that's the kind of very predictable stuff that I'd rather bet on, that kind of improvement that I can see exactly why it's going on, than to try to think, oh, maybe management's going to buy something else, it's going to work out, they're going to get synergies and all that kind of stuff that may or may not happen.
And just looking at their cash flow statement, not a lot of cash acquisitions over the past 5 years, about generating sort of like this cash flow is going up here, but generating about 6.6, so call it about $6 billion of free cash flow on a market cap that's 135. So that's a pretty decent cash flow yield.
Yeah, and they've been also good at taking advantage when debt is super low. Like I don't remember the exact number, but I think they raised some bonds of like 1.something%. So if they can buy back their stock at a high yield, almost free money for them.
Oh, got it. So here they've been borrowing money or increasing their debt issued to buy back stock, but I'm guessing their balance sheet isn't in really good shape. So they probably have some capacity to increase that. So total debt to capital sort of has been growing 40% now. It's kind of interesting. Cool. So this falls kind of like squarely into a kind of steady growth business, compounding, not a lot of surprises, but this is somewhere where you can park your money and you feel confident that the management's going to be a good steward of capital.
Yeah.
Cool. Love it. And this name, Texas Instruments, doesn't get a lot of kind of publicity, a lot of chatter, because it is such kind of like a almost boring, steady growth company. But I guess in the context of a portfolio and a long-term investment, that's actually the kind of thing you want.
Yeah, it's not sexy at all, and like it's easy to understand what AMD or Intel does. Like they have this big, sexy aligner processor that you read about. But Texas Instruments, people like when you talk about this company, most people think about the calculator they had or something like that. It doesn't have like real headline-grabbing products that people will be familiar with. So it's harder to understand.
Got it. Cool. Speaking of sexy stocks, I think you were going to talk about another one that's a little more sexier.
Yeah, that's very sexy. This one is Nvidia. It's basically one that I've just loved to learn about. It's super interesting space. Once again, like I don't know anything. I'm not recommending. I'm not like saying you should buy it. I'm just saying I've been reading a lot about it recently. I've been writing about it too. And it's one of these companies where I used to be a gamer. I still consider myself a gamer, as in like the culture of gaming, but I don't have time to game, so I kind of follow it from afar. But growing up as a gamer, like these GPUs were like incredible when they came out. I remember how you could see through the water in Quake and things like that. So I've always been following the space. And in recent years, I've kind of rediscovered Nvidia, but it was kind of during the big crypto bubble in 2017. Mm-hmm. And at the time, like it turned me away because I didn't feel like I could predict it. Yeah. It felt like the company is going to benefit a ton from this, but from one day to the next, it could all be gone, either because crypto is just a fad or crypto continues. But it was clear even at the time that crypto, all that mattered for the miners was how efficiently you could mine, and that general purpose GPUs were not going to stick around forever. Like ASICs and chips dedicated to only like doing these hashes very, very fast for very, very low cost were going to take over. So it didn't feel like I could predict where Nvidia was going. But after that kind of passed, I got interested into it again when I saw how well they were doing with this whole new wave of AI and machine learning, and how they were getting a lot of traction in the data center. It's a company that's been built on top of gaming, but they've been very smart about reinvesting into like different options for the future. And the one that's paying off right now is this data center stuff. They've been super smart about buying Mellanox. Now they're trying to buy ARM, and basically right now Moore's law is kind of losing steam at the same time as compute requirements are exploding because of all these machine learning models. And so the only real way to do it is to go through acceleration. And Nvidia spent years and years building the whole stack. Like everybody thinks of them as like a physical card you put in your computer or chip, but like they're mostly a software company. The CEO joked recently that, you know, I don't remember exactly how I said it, but like they're software companies because he's pretty sure that the guys at TSMC are the one making the chips, and they just send them basically an email. You know, it's all digital. They have more software engineers than people working on the hardware. And for all these years, they've been building this stack for acceleration of all these ML and AI models. And all this investment is very hard to catch up. It's very hard for others to catch up with. And they basically own that space right now. The main competition will be like hyperscalers like AWS and Google and Azure doing their own specialized chips like the TPU that are very, very good at doing inference for these AI models. But it's a little bit more complex than it seems, because it's very hard to compete with Nvidia for kind of more general acceleration, because they have this massive R&D budget and tons of engineers. So people compete with them like on the more specialized things. So the TPU is more specialized into this area of machine learning. So it may be less expensive and you don't have to pay Nvidia's margin. But if you can't keep utilization of it as high as you would on a more general GPU, like the Nvidia solution might still be less expensive, especially if you have to, you know, write a bunch of your own software. Like Google may have the scale to do it, but they still have to think, like, especially when they're renting space in their data centers to others, if like they have all these specialized racks of chips that can only be used like 60% of the time because like at night or this or that, they don't have enough demand for this type of inference, while they have these NVIDIA GPUs that may be more expensive in absolute terms, but they can keep utilization closer to 100% because they can, you know, throw all kinds of workloads at them. You know, I think that makes them more competitive than they may seem, even with the specialized chips from the hyperscalers.
Right. So
that may be geekier than you wanted.
This is super interesting in terms of kind of like, you know, you look at a stock like this trading at 50 times earnings, obviously priced for a lot of growth in the future.
Yep.
And one of the big questions is, if the market is so lucrative, why aren't other companies entering the market? And the answer is because it's not easy. And even if you're a Google or AWS and you sort of say, hey, we're going to make our own chip, you may create something that does some of the job, but you basically don't have the expertise and the knowledge base to really build upon, which is something that, you know, Nvidia, like you said, has been creating GPU chips and gaming chips and high processing chips for the past 30 years.
Yeah. Even if you make a chip that's competitive, you have the software, you have the APIs, and Nvidia has been around long enough that a bunch of their biggest customers have optimized their software for it. So Adobe may have optimized like all of its creative stuff for it. Like a bunch of, I don't know, there's hundreds of companies that are using the CUDA platform, and over time they optimize for it. So it's kind of like how I think it was Gavin Bigger again saying how Intel has a big advantage because over time lots of people have optimized their compilers and their software for Intel's chips. So the same thing has kind of happened with Nvidia, and they also have been like planting all of these other seeds. Like they have investments in self-driving cars and healthcare and robotics and industrial applications. And like right now it's data centers that's paying off. But in I don't know, 5 or 10 years, another one may be exploding in growth, and then someone's going to notice that and try to compete. But the investment was made like 10 years ago. And they're such a fast-moving target too. Like there's a bunch of startups trying to make chips, but almost none of them are trying to attack them head on, because like just the new generation of chips from Nvidia is such a big leap forward, and it's even more general than before. You can do inference and training on the same chip. That, you know, people when you look at the benchmarks in the field, there's a bunch of companies not even submitting benchmarks because they know they would get beaten so bad by Nvidia. They don't want to show on the slide because it's kind of bad for business. But like if they were to slow down a lot, then maybe I'd be worried that competition could catch up. But especially with the CEO they have now, they're moving very fast and they're looking very far ahead. So that's a difficult target to hit.
So if I pull up, like, let's say we pull up the market scatter plot and we just sort of take SMH as a proxy for semis, and we look at market cap. We look at market cap versus year-to-date return, and you have Nvidia and TSM really kind of leading the pack now, especially with Intel's current problems. Like, how do you is sort of like what is the threat to Nvidia? Is it only AMD because they're in GPUs also, or is it sort of some of the other chip makers potentially as well?
It's a good question, because right now, like, others could kind of eat away at the edges of some of the things that they do. but nobody's in a position to really compete directly. Like AMD is competing on some gaming stuff, but in the data center, especially now that they have Melnuts, and if they get ARM, like I think ARM is a brilliant move. ARM is in like, I don't remember the exact number, but they sold like 180 billion chips or something like that. Like it's absolutely everywhere. And the value of an ARM chip to an ARM customer is X. But if NVIDIA could like have a pipeline to put some of its own IP through the ARM products, then the value would be a lot higher. Like if suddenly my ARM chips could also, like, I don't know, have some AI acceleration, some machine learning acceleration, better GPU performance than what I could get from Imagination or some of the other vendors there. Like the ARM revenue they could get there would be a lot higher, and it would also, like, it's not even a defensive move, it's an offensive move, because ARM has been gaining traction in the data center and competing against the CPUs made by right now Intel and AMD. So it's more, I'm not so much afraid that NVIDIA is getting attacked. It's more like NVIDIA attacking everybody else right now.
Got it. Interesting. So so using ARM as a way of bundling kind of technology and then providing kind of like a higher value add service through different channels.
Yeah, I think they're going to do like 3 different things. I think they're going to try to improve ARM faster than ARM was improving under its current management. I think like they have great management. They have a ton of great engineers. I think their resources are going to help ARM move even faster. So it's going to be harder to catch up with. Then I think they're going to use some of their IP and kind of offer it to all of the ARM customers. So you don't have to take it, but when you're building your ARM chip, you're kind of buying the IP and the designs and the Cortex design and all that. So now you're going to have more choices, like a bigger menu of stuff, and a bunch of people are going to take some of that because NVIDIA's IP is very competitive.
So it's clear that NVIDIA's on the offense. They're looking for acquisitions. They're looking to attack some of the other kind of like maybe middle of the pack here. And if you look at like Intel, they've obviously been losing a lot of ground to different, I'd say, attackers, both on the data center side. Yep. And on the computer side as well. I
think that one of the dangers for Intel was always that they're doing a lot themselves. They're very vertically integrated and they're fabbing their own chips. And now that's been a lot of their problems in recent years. They haven't been able to, reach their milestones, and they've had a bunch of yield problems with their fabbing. And NVIDIA is kind of not fully, but kind of protected from that because they're outsourcing the fabbing to TSMC and Samsung and others, so they can benefit from all of the scale that TSMC is building, or Samsung. And if one of them stumbles, if TSMC has trouble, they can go to Samsung, they can go to Global Foundries, they can, well, anyway, they can kind of move the fabbing around. And that's another thing that kind of one less risk for NVIDIA, I'd say.
Yeah. I know we didn't plan on talking about Intel, but just looking at this long-term chart, looking at just like where it is in the trend, which is kind of like at the bottom end of the trend. I don't know much about semi companies, but just thinking about Intel, like having so much IP and having so many assets and history, trading at nine times earnings. So if we look at kind of like, let's look at Intel PE, it's got to be trading at 10 times forward earnings. And I don't think NVIDIA is the right comp because they're different, obviously, companies and growth profiles. But just kind of like having a longer term bet that Intel figures it out, and as the market's going to reward it with a higher multiple, I think is a very tempting thing to consider as a thesis. But obviously they're having a lot of issues, and it'll take some time to turn the ship around.
Yeah, I don't have a crystal ball, but there's some interesting stuff that could happen with Intel because the US is going to have some big geopolitical choices to make about semiconductors and who they want to be dependent on. And Intel was a big national champion. They're fabbing a lot of stuff in the US. And it's kind of bad timing for them to be stumbling right now as there's tensions with China, with TSMC, consolidating everything else, and Taiwan becoming such an important country for the industry and for the world, because everything's now built with semiconductors. So you have these companies like in the Netherlands, like ASML, designing the machines that make the chips at TSMC, and like this kind of part of the supply chain is very undiversified and very strategically important for all these big players. So if Intel could be revived, could be made to go back to its glory, I think there's going to be a big incentive to help them get there. I just don't know if they have the right management to do it right now. I think they've started to divest some stuff like their flash memory business, but I don't know. Like one of the best engineers of all time is Jim Keller. He's been designing semi stuff at different companies, and like he goes to a company, works there a few years, and then they come out with something incredible, and then he moves somewhere else and they do something incredible. And he was at Intel like not that long ago, but he didn't stay. He left after a short while. So that makes me think that there's kind of a structural problem there that's not engineering, but maybe something else, maybe with management or culture, or I don't know. But it's just like, I don't really know, as I was saying, but I'm guessing.
Got it. So that makes it seem like this turnaround could take a little bit longer or might not even happen. And maybe that's why the market is ascribing it a 10 times multiple versus if we just look at the multiples here on the market cap versus PE. Intel has to be right. So Intel is the lowest multiple of all the semi chips at sort of 10.5 times. That's pretty incredible. And it's also incredible. You have chips trading at 50 to 60 times, and then others are trading 15 to 20 times.
And one kind of thing that if you had told me years ago, I would not believe. But if you look at market cap charts for like Nvidia and Intel, like they crossed not that long ago, and like Nvidia is already now almost twice the size of Intel.
Wow. Right. And
so like Nvidia was just like, Intel could have bought Nvidia as a bolt-on not that long ago, and now it's bigger.
Right. So before this kind of like AI,
crypto for a while, and then kind of data center AI stuff.
Right. So Intel here, 180. So this was a $10 billion market cap.
It's a log chart.
It's a log chart, right? So that's if we change it to linear, it's going to be much more clear here. But log gives you a good sense of percentages. But here, $10 billion company, and if we look at Intel FA.CF, so they basically could have done it with let's see, cash flow from operations in 2010 was okay. So they basically could have done it with 1 year's worth of cash flow to purchase Nvidia in hindsight, when everything is more clear.
Yeah, and that's one of the things with Nvidia. I can kind of go back to the discussion there, is a lot of startups and young companies are trying to compete with them. And if Nvidia was kind of an old, boring like IBM company, they would have trouble attracting talent. But the stock has been doing great. The growth's there. It's still an exciting place, even if it's 300 billion. So that's another big advantage that they have.
Got it. So just like success attracting talent and more success.
Yeah. That's like with the big FAANG companies. A bunch of people go there, work a few years, and then they leave to start a startup and try something because they feel the company is too big and it's not like the future won't be as bright as the past. But for Nvidia, recently at least, that's not been the case. We'll see going forward. You never know. But I feel like the ARM acquisition is going to kind of create another big playground for engineers to build all kinds of new stuff. And if I was an engineer in the field, like it would be one of the top companies I'd look at. I wouldn't feel like going to a small startup, because as soon as you have like physical products and manufacturing and all that, it's so capital intensive, so difficult, takes so long that the chances of success are very low. It's not like a B2B SaaS company where you can just spin it up on AWS and do it a couple of people in the apartment. So it's harder to compete with.
Yeah, got it. Interesting. Cool. I think you told me before this you had these two companies to talk about. Is there another company or another investment, perhaps maybe one that isn't well known, that you're sort of keeping in your pocket that you want to discuss? Could even be half baked if you want.
Nothing super specific. I could talk, I guess, about some of the companies I've been learning about recently. One of them that I find super interesting is Crowdstrike. But I'm no expert on it. I like the same caveat as before. Like I don't know anything.
Yep.
But it's a cloud security company that started with endpoint protection. So like computers and laptops and mobile device and everything. And the premise is kind of like you put their software on all of your devices, and they monitor stuff. And if there's behavior that seems weird and strange and it might be a breach or something, then on the endpoint, the aperture is going to open up. It's going to send more data back to the mothership in the cloud. And if it detects a problem, it's going to solve it there, but it's going to learn about that problem and try to cover all of the other endpoints with what it learned. So it's kind of like the intelligence is in the cloud, and it's gathering data, and it's kind of sharing across all of the surface area that's covered by the company. And that compares to legacy companies that are security companies that have been built over time by acquisition. They have all these different systems that are not well integrated together. They have these old antivirus software that's still scanning for signatures, and like all of this old technology doesn't have this kind of they can't ship easily the data back to the cloud to learn from it and immediately protect the rest. They seem to be kind of stuck in an old paradigm, which leaves a lot of room for CrowdStrike to gain share, especially as there's one of the big player things, Symantec. They've kind of abandoned a large part of their market because it wasn't profitable enough. So that's a bunch of market share that CrowdStrike could take. And what I find most interesting about CrowdStrike is they didn't just stop there. They started adding more and more modules to their endpoint. So you still have the single software on your device or your computer, but then you can sign up for different modules that do different things. So some of them could be like they check if your software is configured well, because a lot of breaches and security problem happen because just of human error, badly configured software. And then so if you're IT in charge of IT and you have thousands of computers, like putting that module on and having the peace of mind of knowing that you can have this high level view of all that's going on your fleet of devices is very powerful. And so as they've been adding modules, like the hard part is selling the first one, is getting people to install the endpoint agent. But after that, people sign up for more modules, basically like pure margin. It's like almost 100% gross margin because they're already gathering the data to analyze it. They're already doing the work. So more modules are almost pure profit. So I kind of imagine it over time improving its economics a lot. And recently they've started pushing more the idea that they're not just doing endpoints, they're doing workload protection. So in the cloud, there's all these containers that are spinning up all the time. And a bunch of them, if it's the software from the cloud provider, from AWS or wherever, it's protected by that. But if you're just spinning up a server and running your own software on it, you may be misconfiguring it. Maybe you're not protecting it well. So they're selling these workload protections, and what they're seeing is that for every endpoint that they're seeing, there might be like 10 cloud workloads that need to be protected that are not protected right now. They're saying that what they're seeing now in the cloud is like 20 or 30 years ago with AV and security software. Like nobody was protected at the point, and then everybody had to be because it's a huge surface area and the bad guys figure it out. So that may be interesting. I don't know if they're overselling it. I don't know if it's going to happen like they say, but it's an interesting company, interesting tech. I've been loving learning about it. Of course, it's growing super fast and it's not cheap, but if they can pull off what they're saying they're doing, if they can become kind of this platform that does a lot more than just endpoint security and keeps adding modules after modules every year. They're doing some acquisitions too. They just did one in zero trust security, which is a whole other area that they could expand into over time. So it seems interesting to me.
Yeah. So just looking at the revenue estimate, revenue is growing 70% next fiscal year, and then 35% afterwards, which is obviously a very high growth company for sales. But I love seeing these trends whenever I look at revenue estimates, like a company being able, or analysts upgrading their earnings estimates for the years out. So company started a year ago. Analysts were expecting $1 billion for 2023, and now they're expecting 1.5, so 50% upward revision.
Yeah, and part of that is because of the pandemic, because everybody has done their digital transformation, like their 3-year plan in 3 months or something. But what's interesting is CrowdStrike has a very good retention rate. They have low churn, and during the pandemic, they had a program where they gave away kind of they had a, I don't remember what they called it, but you could get protection for a bunch of endpoints, and you only started paying like I don't know how many months afterwards. So some of those new users haven't been paying so far, and that's coming down. And then once you have the new users, their net expansion rate is high enough that over time they're probably going to sell more modules and all that. So even that revenue revision may be undershooting on what they're going to do. And with these types of companies, I guess if you're making a bet on it, the bet you're making is that it's not going to be 35% next year, and in 2022 it's going to be higher than that. Like it's expensive. It's expensive if the growth rate decays at the rate at which it's predicted. But if they can somehow maintain it, if they can expand their TAM and their number of modules and everything, if they decline the growth at a lower rate, it could be not that expensive after all. But I don't know. That I don't know.
Got it. Yeah. Certainly seems like they're setting themselves up for upside, and they've been able to deliver upside over the past year. But like you said, let's see on on revenue trading at 34 times. Their fiscal year is, I can't see it from here, but fiscal year 2021. So I'm imagining it's halfway at some point during the year. Oh, here it is. It's there. So it's over in their fourth quarter is over in January. So this is January 2021, so almost over, and then January 2022, trading at 25 times, pretty much next year's sales revenue, which is pretty lofty, but for something that's growing so quickly, it might be worth up to pay for it, which is definitely the theme of the past couple of years.
And the question is, with these companies, what's the end state looking like?
Right.
So, is it going to be like an 85% gross margin, 40% free cash flow margin company in X years when the growth tapers off? Is it like that? That's the question that I don't know, but that makes a big difference. Some of these companies, competition is going to come in. The unit economics are not going to be that great, but the companies that win their vertical and become the thing there, the kind of big platform that everybody goes on, these could do very well.
Yeah.
If you win this type of security, is a $30 billion market cap, big for that kind of space, that gigantic space. I think they were saying in a recent presentation that for cloud workloads, the industry as a whole is spending like around 1% of its IT spend on security, and that seemed very, very low. And they were saying that I think Gartner and a few of these guys were saying that a more reasonable rate of spend on security would be between like 7% and 10%. So if that's true, if that happens, that's going to be kind of a big tailwind.
Got it. Yeah. Obviously, security is such a big issue now. Will continue to be an issue. And like you said, $1 billion in revenue and a 30 billion market cap. What does that look like 3 and 5 years from now? And what's the potential upside for that? Which is an important question to answer, a concept to think about for this investment. Cool. That's awesome. Great stuff. So three excellent ideas that you gave us. Just wrapping things up here, wanted to cover 2 more things. Number one is I know you have you're on Twitter, you have a Substack. Can you just tell people if they want to follow your ideas, follow your thoughts, but what's the best way to do that?
On Twitter, I'm Liberty, but the username is LibertyRPF. And people curious about it. I couldn't get the name Liberty, so I had to add some stuff. And I was thinking about Richard P. Feynman, one of my heroes, a physicist. So that's what RPF stands for. So the Substack is the same. It's Liberty RPF. You can go .com or you can go .substack.com. And
why the satellite icon in your Twitter account?
I think it was random. I think I had a background image on the wallpaper on my computer was this, I think it's in Chile. It's a radio telescope. So it's a bunch of radio telescope dishes. So I just picked one of those and used that as my avatar.
Got it.
It's the Alma millimeter wave radio telescope.
Got it. Richard Feynman would be proud. Cool. And last question, everyone's sort of stuck at home. Is there a show or movie that you would recommend for people to watch on Amazon, Hulu, or whatever?
I don't know if everybody's already seen it last year, but the miniseries Chernobyl on HBO is great. I've only seen it a few weeks ago for the first time, and it's one of the best shows I've ever seen.
Cool. I saw it. I saw it after. I think it came out right after Game of Thrones ended, because I was like, "What is the show they're trying to throw at us?" And it was really, really good. So I definitely I enjoyed that and recommend that as well. Cool. Liberty, thanks so much for being on, for providing us with your investment insight and your ideas. And I'll talk to you soon.
Thank you. My pleasure. I love Koyfin. Keep up the good work.
Thanks. Bye-bye.